Good morning, good afternoon, good evening, wherever you are. I'm your host, FD for Sage5.tv, and in this video, we want to look at Ethena and this ticker symbol ENI in one of our favorite segments, which is Weekend Focus, where we are looking at the cash and carry mint for crypto dollars. If you want to know more about this, please keep watching. But before I proceed, please note that this is not financial advice. These are just my own opinions. If you are seeking financial advice, you need to find someone who is actually trained to give you financial advice. The information contained in this video is just for educational as well as for entertainment purposes. And this content is also not targeting UK audiences. So if you are from the UK, unfortunately, you are not supposed to be watching any crypto related content according to the authorities. Please do your own research. If you are from the rest of the world, welcome to our channel. Please do consider subscribing to our channel. We do rely on you guys. So if you do want to support us, please subscribe. And now and then, please watch our videos to the end and click like and subscribe if you're not subscribed, as well as commenting in the comment section so that we can engage with you guys from time to time. So what is Ethena? Ethena is a crypto native cash and carry mint. Deposit crypto, for example, ETH or BTC, take equal and opposite short paps to neutralize price swings. And you've manufactured a synthetic dollar called USDe. Stake that USDe and you get sUSDe, Ethena's reward accruing internet bonds, powered mainly by derivatives funding, basis plus any backing asset rewards. All of this is designed to work out depending on traditional bank rails. Some key features for Ethena include what's known as delta neutral stability, where USDe tracks the dollar by backing spot crypto with offsetting short futures, perps, or delta-hedged. Next, you got reward accruing USDe, which is the internet bond. If you stake your USDe to get sUSDe, rewards drip in automatically per Ethena's distribution logic. Negative protocol revenue isn't passed through stakers, reserve fund basis. So if there is negative revenue, it's not passed on to people who are staking their USDe. Bank independent design with transparency. This is protocol positions and custody, which are structured to avoid reliance on bank deposits. Custody uses off-exchange settlement providers and hedges on multiple venues. Next feature is the mint and redeem architecture, where on-chain contracts with whitelist, KYC, direct mints and redeems. Broader access via secondary markets. Next, you got multi-asset backing or governance approved. Here, if you've got ETH or BTC and others, but I think you can also hold liquid stables like USDC and USDT as part of backing. Ethena governance, that's another feature. Ethena governs protocol decisions, for example, electing a risk committee with scope expected to expand. So that was on features for Ethena. Next, let's look at the value proposition. What is the value being proposed by Ethena here? For users, a dollar-like asset not parked in a bank with the option to earn crypto native carry via USDe. Reward flow driven by PEP funding or basis and backing asset rewards. As for builders or treasuries, on-chain scalable dollar liquidity that can settle quickly and compose across DeFi, while hedges sit on diversified venues via off-chain settlement. That's on value proposition. Now let's look at some of the use cases for the Ethena protocol. First, you've got yielding cash lag. Park working capital in sUSDe to capture crypto carry, where APY varies with funding and basis. You can also use USDe as a trading settlement unit or DeFi lag, where a bank independent dollar is desirable. I'm also aware that some of this terminology and language may not be obvious to those who are not familiar with PEPs and hedging, but please keep watching and pay attention. Next, you got what is referred to programmatic treasury management, where whitelisted entities can mint or redeem against approved assets via API, integrating Ethena into workflow tooling. And you also have this simple user experience for end users. Non-whitelisted users can still buy USDe or stake to sUSDe via supported interfaces and partners. That's on use cases. Let's look at why Ethena is performing well and why things are working for it this cycle and what could power the next cycle for Ethena. Let's look at the current cycle tailwind. Currently, we are looking at positive funding in bull markets. In 2024, BTC and ETH PEPs carried double-digit average funding, and sUSDe's APY averaged in the high teens that year, precisely the environment Ethena monetizes. Next, bank-light stable value. After years of bank-exposed stablecoin drama, a design that's a crypto collateral plus hedges rather than cash in banks resonates with DeFi natives. So if you are solely about decentralized finance and you are scaling skeptical about centralized banking or traditional finance, Ethena could be the protocol that you actually need to be looking at. And that could also point to a situation where if this takes off and legacy finance, for whatever reasons, crashes, Ethena could become huge, for lack of a better word. And next, let's look at scale via existing derivatives liquidity. The Ethena model taps deep centralized finance and derivatives venues with off-exchange settlement, which helps capacity and operational safety. And what could sustain future success for Ethena? Well, if there's consistent and persistent PEP demand, as long as leverage demand keeps funding and base is structurally positive, the internet bond remains attractive. If funding turns negative for long stretches, yield compresses, which leads to funding risk. Operational resilience, where we will be looking at multi-custodian off-exchange settlement, and add to that multi-revenue hedging, which should mitigate single venue failure shocks. Exchange failure risk is covered in Ethena's documents. If you want to know more about what that means, I'll leave some links to that section. And then finally, we've got inner governed risk processes. For example, risk committee elections that can adapt collateral, venues, and limits as markets evolve. But here is some reality check when it comes to key risks. Prolonged negative funding, custodian or venue outages, and backing assets, LST issues are all explicitly recognized in Ethena's risk docs or documents. So these are some of the risks. Before you jump into Ethena, you need to read their reality check when it comes to key risks. You need to understand what they stand for and what could happen to your funds if certain things play out. So what are my final thoughts on Ethena in this week in focus segment where we are looking at Ethena? I think Ethena bottles crypto's favorite soda, so to speak. That is PEP funding, if you didn't get that. And it labels it internet bound. When the market fizz, that is leverage demand, is lively, sUSDe tastes great. When the fizz goes flat, it's just dollar water. Be aware of that. The good news is that Ethena's plumbing or delta-hedges of exchange settlements and governance is built for real kitchens, not lemonade stands. The job for Ethena holders and users is the same as any sommelier. Mind the vintage, which is funding, or respect the seller, which is risk. Don't confuse sparkle with safety. Until the next one, guys, FD for sech5.tv signing out for now. Bye.